Can you actually buy property, save taxes while still growing a property portfolio? In this video, I want to cover off what it looks like when you buy new versus old, as well as what depreciation means and how you can level up your portfolio if you're really trying to build out a real estate portfolio to retire. It's very different from trying to just save taxes. So if you're interested in what my thoughts are, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now picture this, you go to your accountant, they go and do your tax refund and it comes back and you're like, I didn't get a refund, I have to pay more taxes. And the first thing you ask your accountant is, how do I reduce my taxes? And they will often lead to saying, well, you should buy property. Not just any property, you need to buy something new and ideally negatively geared. Now, in an environment like right now, where interest rates are so high compared to where they were over the last couple of years, you will find that most things are negative cash flow. So the negative gearing part, yes, tick, but you need something new because if you get something new, you will get the benefit of depreciation. Now, I've covered off why you shouldn't buy house and land packages. You should check out this video. Please, I urge you, if you're in the process of doing so, you need to get out, especially after you watch that video. But at a high level, the TLDR is that when you buy something new, you're in an area that may not have the ideal metrics in the short term as well as the long term when it comes to capital growth. You just get sold on the idea that it's new, everyone wants to live here, it's the new growth corridor, and why would you want to buy something old when you can buy something new? There's less maintenance, right? I would go on to argue that most of the stuff that gets built today versus 15, 20 years ago is complete dog shit. Now, apart from that, you've got to be careful on who refers you to these new house and land packages. If it's your broker or your accountant, or it could be both, then you definitely are in trouble because they will get a massive kickback, and that is how they make so much more money than actually going and doing loans or doing the accounting for you and your tax returns. That is a fact. Now, I'm not saying everyone does it, but if you're getting referred and there's no costs up front, then you should definitely be wary. Now, the other thing that I would urge you to think about is, why would you go to an accountant to get advice on what property to buy? Equally, why would you go to your broker to ask how to save taxes? You're asking the right questions, but to the wrong people. And that's where, if you're talking to a buyer's advocate or a buyer's agent, they are only going out there and helping you when it comes to buying property. They should be able to source you the right property. Now, when it comes to property strategy, not every buyer's agent's the same either. And I know this because so many of you have started a career in the BA space because of watching my videos, which is super awesome because I think more people actually need help. But the problem is that a lot of people are coming into the industry without the experience. So they may have no idea how to build a portfolio and how to structure it so that you've got long-term growth and you can continue borrowing to be able to purchase all these 5, 10, 15 properties that you actually want to be purchasing. So buying the property is one thing, but having the strategy and the backing to be able to execute on those things is a whole different ballgame. Now, before I get off topic, let's come back to this whole idea of taxes. When you go out there and say, I want to save my money, I don't want to pay taxes, I want to save on taxes, what you're doing is you're operating in a mindset of limitation. What you want to be operating in is a mindset of abundance. So you would have heard this, think with an abundance mindset. If you're like me, your TikTok's flooded with all this motivational, inspirational stuff by people who've gone out there and killed it. And they always tell you one of the key traits to success is having an abundance mindset. There's more money out there and you can just make more rather than just saving what you have. I'm not saying that saving and saving on your taxes is a bad thing. I'm just saying that you can't do both. And you need to make a very clear distinction between what you're actually doing here. Is it that you just want to save more money and save your taxes? Great. You'll live in this portion of life and that is completely okay. But I think where the problem is that most people think this is what they want, but in reality, they want to go out there and live the life of financial freedom. I hear it every day. I want to retire early, Ravi. I want to have a portfolio that can one day pay for my expenses. If that sounds like you, smash that like button. Because apparently the universe sends more energy towards you to get to those goals by doing so. As a byproduct, it also helps the channel. So I would urge you to think about what you're actually after. Is it to save taxes and live in this space? If you're trying to achieve that 1% life, then you're going to need to do things differently. How many people do you think every year go to their accountant and say, I want to save taxes? Now, although it's a great bonus to save taxes, I don't think I've ever asked my accountant, how do I save taxes? In the last 5 years, I've said, how do we structure things better so I can keep moving forward? That's the discussion I have. And he always comes back to me at some point and he's like, Ravi, your tax bill is going to be great this year. It's going to be huge. And I'm like, great. Because if I'm paying taxes, that means I'm making money. And that is a good thing because I can keep using that money to go and leverage my position, whether it's in my business to keep growing, whether it's going to acquire more businesses, investing in other things, as well as investing in property. That's the mindset that I operate with. And that, I think, is how you're going to get better aligned with the results you actually want. And I'm going to show you an example because I'm a really nice guy and I'm here on YouTube all the time. Let's figure out what this depreciation and how much of a benefit it can actually make. Now, for example, if you go out there and buy a $650,000 home and land package and the build component is, say, $400,000, how depreciation works is on paper, this accounting figure of 400,000 gets depreciated over 40 years. So in effect, it's saying that, oh, well, the house itself is depreciating. So, Mr. ATO, what you need to take into account is, although I may be making money in my everyday work, I've actually got an asset that depreciates. Poor me. Now, in reality, we know that land appreciates, buildings depreciate, but we know that house prices go up. So you're effectively using a loophole, but it's completely legal. And so what would happen is they would say, okay, you have a property for 400K, which is the build price. And I'm not going to consider the land component. I'm going to say for this purpose that your building will depreciate to $0 in 40 years. So that means they will simply go 400K divided by 40 years, which is $10,000. So on paper, you're going to have a loss, which is depreciation of $10,000 to knock off what your income looks like. So if you made $10,000 that year and your building depreciated by $10,000, it will effectively mean you pay zero because your income is zero. Now, so far, this sounds amazing. But when you actually think about this in reality and in practice, I think you're going to maybe rethink this. Because what happens is that $10,000 then has to go against your tax rate. And in most cases, it's maybe 30%. So realistically, you're only really getting the benefit of $3,300. Now, although saving that sort of money could help towards maybe a small holiday every year, I want you to think bigger. My motto this year has been for myself and for my business to think bigger, big. It's not just thinking about bigger, it's going bigger than that. Now, let's look at some examples as to why I would opt for a different method. Most times when you're purchasing a property like this, it's probably not located in the area where the numbers completely make sense. You need to use data to be able to know if you're buying in the right area for that long-term growth, not just with capital growth, but also rental growth. Is there going to be demand in the short term and the long term? There's areas of Sydney that I 100% know saying to people, you should probably avoid even 4 years ago, which is when we had such a massive boom in property prices, but people still opted to go there because it was the next big thing. It was like, hey, this is going to be $1 million suburb. And over time, yes, it's become $1 million suburb, but the rate at which it grew and the amount that it took in terms of just holding that property, even when interest rates were low, was significant on most people's budgets. Instead, if we had gone out and just purchased well across Australia, you would have had a better cash flow position and you would have made significantly more money. And this is why I'm so confident in this strategy, because I've been doing it for 11 years myself personally. So I would much rather go and invest in an area where the numbers make sense and I can get above average growth versus going into an area that, yes, sure, I can save some tax, but when I look at my net position at the end of the year, and you should be operating this like a business. So if you look at the net number at the end and you say, well, sure, I got to save a little bit here and make a little bit less here, I'm in a position that's actually worse off than if I had gone down this other strategy. And to showcase what that looks like, I'm going to show you the same property with 3 scenarios. So what we have here is a $650,000 home at an average growth rate of 3% for 5 years. And after 5 years, that property now would be worth $753,528. So it still looks pretty good. But if you're going to account for things like inflation, it hasn't actually been that great. Now, why would I show you 3% when the average is 7%? Well, you've taken a haircut because you probably bought a house and land package where there's so many marketing costs bloating up that price and people get their referral fees. It means that you're not actually buying something that's technically worth $650. It's probably worth a lot less. You're also buying into an area where there's probably a whole land release where there's other demand there, but the supply is going to outweigh the demand in that short period of time. So you're in a position now that you've made some money and you're hoping for 3% growth, although in some areas it's probably gone backwards. But then what does it look like if you just said, okay, I don't care about the taxes. Let me go and just find a property that is average. And so you go out there and buy something that's average in a different location that might be a little older. Now that $650,000 is worth $911,658. More than $150,000 more in terms of capital growth. Now keep in mind, this is all tax-free. Equity on your property is tax-free. Now, when you sell, yeah, sure, you're gonna have to pay capital gains tax, but it's one of the lowest taxes that you ever have to pay. So in this case, you're actually significantly better off, because if you're just saving $3,000 on your tax refund, you're letting go of the potential to make an extra 150K. Now, I'm gonna take this a step further because I guess I can. And in this example, I want to show you what the average is for search property clients. And the average for search property clients, including myself, is 11%. So just a small difference between 7% and 11% couldn't make that much of a difference, right? Well, it means that that property for $650 after 5 years would be worth closer to $1.1 million. And that would mean $445,287 in tax-free equity. That's capital growth you've experienced. If you look at the difference between what we do versus what the average market would look like, it's a difference of almost $200,000 in just 5 years. So imagine what that looks like when you extrapolate that out for 30 years. And if you compare that to just going, I'm gonna go with one of these providers that told me, hey, I should buy something new because I get to save on some tax, well, then you're looking at a difference between $100,000 to $445,000, which means a difference of $350,000 or thereabouts in 5 years. This is why when I look at people's portfolio even today and we're restructuring things, I often scratch my head thinking, have you not done the numbers and looked at what my net position looks like? And again, we only know what we know. So if you're not having these conversations and you're unaware of these things, unfortunately, a lot of people make the mistake and then ultimately try and fix it. And at that point, it's probably too late, or you've experienced a lot of damage towards your portfolio anyway. Now, the next part to this that you've got to consider is negative cash flow versus positive cash flow. And I won't spend too much time on this, but the reality is so many people, when they're buying, they're trying to buy new, which we just addressed, why it looks like a pretty silly idea, but also with negative cash flow. Now, right now you might be cash flow negative, but if you're negative cash flow by between $5,000 and $10,000, that seems pretty normal. But some people are actively going out there buying property that is negative cash flow on purpose by $30,000 to $40,000. Because why? I get to save some taxes, and I'm hoping that the property grows in value. I've been told it's blue chip, it's gonna go up, but the reality is, what is blue chip? What you want to look at is supply and demand ratios, understand that there's demand in the area, as well as that infrastructure spending, and what the short-term metrics are. You can't just say, oh, well, this is a blue chip area, I'm gonna trust whatever happens, because past performance is not indicative of what happens in the future. And this we've experienced in many areas where people said, don't buy here because it's a shit area, but you haven't considered that there's so much change that's coming into the area and is why that area has experienced so much growth and will continue to outperform other areas. Two things when you're considering negative cash flow is that one, it will definitely affect your lifestyle. If you have to suddenly put $500 extra towards this property, it doesn't feel so great. You're gonna have to think about it and you will stress about it. Equally, if your tenant leaves, you're probably down in the pocket about $1,000 a week, and now you're probably forced to sell at the worst time because that's how the markets work. But on the flip side, if you have a negative cash flow property today, which is slightly negative, when you forecasted your rental growth over the next 2 to 3 years, you're probably in a neutral, if not positive cash flow territory without even interest rates changing. So if we have interest rates change, you'll probably get there a lot quicker. And why this is important is because you can then hold more properties. And that links in with the second point, which it definitely affects your borrowing capacity. You can buy one property and say, well, I get the tax benefits, but if that stops me from buying my second property, a property worth, say, $450K, at 10% growth on that is $45,000. Even if I had to wait 3 years to experience that $45,000 worth of gains, it would still outperform what benefits I would get by just having a negative cash flow property, just trying to reduce my taxes. Because again, that tax-free equity is tax-free. If you want average results, then go ahead and do what average people do. But if you want that big portfolio and you want to achieve the 1% lifestyle, then you have to do things differently and you need to align yourself with the right people to be able to execute on that. I'm going to give you the shameless plug, but at this point, it's because I need you to start taking those actions. If you want the help and you need the team right behind you, I'm going to leave a link in the description below to book a call with our team. It's completely free. You can have the strategy session, start building out what the roadmap looks like, and if it sits well with you, then you can move at speed. This is the whole idea, is that people will come to this point and say, oh, okay, he's just trying to sell me shit. It's like, yes, but you've just invested all this time to listen to this video because this means something to you. It's important to you for you to be able to go and be self-sustaining, help your family, help yourself, and get to financial freedom. So why wouldn't you get the extra help? Sure, everything in life costs you something, but if you can think about this as an investment rather than a cost, I think that's going to change the way you approach things, especially when it comes to buyers agencies, buyers agents, or trying to buy the right property at the right time. You need the strategy as well as those properties. So I'll leave a link in the description below. And I hope you guys have enjoyed this video. If you have, smash that like button, subscribe if you haven't already, and I'll catch you guys in the next one. Thanks guys.